Hello and welcome to New Wave, the podcast where we dive into one big question. What's making waves in European climate tech this week? Joining me today are Julien Attwood, Head of Research at Sightline Climate, Julien Fredonie, Head of Venture Investments at Hyundai Innovation, and Jonny Everett, co-founder at Marble, a venture studio in climate tech. In today's episode, we will dive into Genomines' Series A round, a French startup that raised 45 million to grow nickel from plants. We'll talk about the rise of corporate VCs in climate and their innovative strategies to finance companies. And we will ask the big question, is climate tech already out and dual use taking over, or is this just media hype? All right, let's get into it. This episode is brought to you by Decarbon, a Belgian startup turning industrial CO2 emissions into valuable feedstock using a plasma technology. If you want to learn more, reach out directly to David or Gilles. I'll put all of the information in the description of this episode. Let's go back to the episode. All right, guys. Well, thank you so much for joining me today. I guess we have a lot to cover, but let's maybe start with Genomines, a French startup developing plants that extract nickel from soil. They just raised 45 million as a Series A. It was oversubscribed, which I was quite surprised with. Jonny, you are an investor there. You've been following them for a long time. What's your take on the oversubscribe for Genomines? Why do you think so many people care?
I think it's a great outcome, obviously for Genomines. I think also for the ecosystem to see that these large, important rounds are happening, and especially across the US-European mix, which I know we'll come back to. As you said, I'm an investor in Genomines. I've been with Fabien and the team since before they raised their seed. So kind of watched them go through that journey from the sidelines, which has been super fun. I think it's important to say that this didn't happen overnight, right? This was a real slog to get here. And in the end, it's come together and it's a beautiful outcome and there's so much to celebrate for them. But I think one of the main points I want to stress is, especially for founders who are tuning in, is this really was a long and quite complicated round to pull together. And so I think they're quite rightly oversubscribed in the end. I think to get to the place where they were committed and then building enough momentum around the round to then be oversubscribed was a long and pretty arduous journey at certain points. I think there's a chronic issue in our industry where people are willing to follow when other people stick their neck out. And so I think once you have the momentum in the deal, getting it oversubscribed becomes hopefully quite easy to do. And I'm not at all minimizing the fact that being oversubscribed is great, but I think there's a lot of people who want to follow in on things once other people decide that they're hot. And I think one of the issues we sometimes have is that there aren't enough people who build strong enough conviction in the early stages of a deal to really lead that. And I think the engine played a pivotal role in being that, key believer and helping to then also bring people through that maybe were interested, but not necessarily able to get over the line themselves. I think there's an interesting kind of round dynamic that played out here. And I also, again, want to shout out to Fabien and the team, because I know this has been a huge, huge slog. And I'm very, very happy with the outcome for them. And I think it's a great also outcome for the ecosystem as well.
Yeah, and something interesting there is I think the word climate wasn't quite mentioned in the release. It explicitly said better, faster, cheaper, the type of new narrative. Julia, I guess, is that something you see more in your research today at Sightline, the better, faster, cheaper is a new way to go?
It definitely is. And it's also about crossing over with the sectors that are strategic right now. So if you look at the US, they're talking about critical minerals, geothermal, and nuclear. And so being able to find something in critical minerals that is on the ascendant, Jonny, you talked about it being a long slog. I'm very glad that these guys have the ability to crunch through a lot of difficulties because the mining sector has huge timelines. It's really difficult to get anything done. And so I think this idea of finding something that also has like positive aspects in terms of climate. I mean, it's using plants rather than digging into the earth. So it's helping to avoid all of those biodiversity and remediation issues is really unique. And I can definitely see why it was oversubscribed with that as a co-benefit.
Is mining the new hot, shiny sector in climate?
And it's definitely one of them. I would say critical minerals, adaptation, and then those clean, firm power sources are the things that we're hearing a lot about, along with the grid, just to help find more capacity. But it's about security, right? Nickel is an incredibly concentrated market. Most of it is coming from Indonesia. And the idea that you could use land that you can't even use for food production to produce metals domestically is incredibly attractive to governments that are increasingly worried about tariffs and trade wars.
Yeah, and I think that's very interesting because it plays to the resilience and sovereignty story that a lot of people in climate are saying right now. I think they were probably at the perfect intersection of the new play, which is resilience, and then the old play, which is climate to some extent. Julien, I know you looked at the deal as well. You were at least like looking at it very closely from our latest discussion. What did you think of Genomines when you first had a look at it? Did it seem like unrealistic to do plants like scaling nickel through plants?
At the end, we do this job to meet that kind of founders and that kind of ideas, right? So this is exactly the type of innovative stories when you hear about them the first time that you want to know more and you want to investigate further. So same as Jonny, I think I've been in touch with them for many years, 3 or 4 years, and I would agree that maybe this is the perfect timing with the resilience and the climate play. I think what is very interesting, I mean, what I found very impressive in this round is that probably this is one of the largest Series A rounds that we have seen in Europe around climate tech this year. So that's a positive signal for our ecosystem in general. That's very positive for Europe, I think, to attract attention from MIT VC. I think there are probably not a lot of their portfolio companies from Europe or from France specifically.
It's the first. Yeah, it's the first non-US deal.
Exactly. So that's a very, very positive signal, I would say. And that's, again, kudos to the team. Now, I would say another challenge starts for them, right? This is the part of scaling and building multiple plans to deliver, to be prepared for the next round. But they have a very impressive team to deliver, and some, I would say some very positive signs of traction already. So I will keep on watching what they are doing. And maybe on a side note, I'm asked often about venture studios and company builders, etc. And if I remember correctly, I think the founding team met at the Entrepreneur First program. And this is one of the examples that such programs can deliver a great value, right? So that's also a positive note also for venture studios and company builders.
Thanks, Julien. I also wanted to double click on something Julia said, and linking to your point about resilience and sovereignty and all these kind of topics that we're hearing a lot about. I think the interesting concept that Genomines have, which we see other companies that attract a lot of interest have at the moment, is this idea of being additive to the supply chain total. So they're able to access a resource that today is uneconomic to access, right? So these nickel-rich soils, everyone knows they exist. It's just it doesn't make sense to go and mine them in the traditional way from a pure economic point of view. And I think that one of the interesting angles that a number of companies are starting to explore is how do we take or access resource pools or resources that previously are not economic or are not able to be used for whatever reason, and use technology to bring them forwards in a way that then they can enter the supply chain. And so there is this point about like total addition, whether we're talking about like addition of new clean firm power, whether we're talking about addition of new metals and minerals. And I think that's a very different technical play to saying we're going to do the same thing, but we're going to make it cleaner. Because there's also the argument about increasing total net supply. And I think those intersections can also be extremely powerful for any climate company or any climate adjacent company.
Yeah, the supply chains are super interesting because like metal supply chains in general, they are concentrated, but they're very international. So like so much of metals processing happens in China. And this is something that Europe has kind of flagged as a risk of like, even where we change where we mine something, if it's got to go through China anyway to do the processing. So I think it's super interesting. It's almost like a leapfrog for Europe's supply chain. If you don't have to put in all the effort to build out that processing supply chain for the traditional ways of getting these metals, then it's just a great accelerant for that.
Yeah, I completely agree on the supply chain and also just on the access to the resource in and of itself, right? Like if you're thinking about, and let's give another example, like geologic hydrogen, it's saying we can find this resource that wasn't previously available to us, right? Or making hydrogen a different way or making methanol a different way. It's like adding to the total net supply. And I think that's an interesting kind of paradigm shift for some of these companies.
So do you think it's not even competing with traditional mining in that sense?
I mean, I think it is competitive in the sense that they're going to be supplying the same product into the industry that's going to be hopefully cheaper and greener, right? Which we hope, is going to be attractive to customers. But I think in the near term, at least, I would expect that they're increasing total supply or increasing total capacity, right? But as those supply curves, if we look at something else, like for example, copper, as some of these supply curves just start to dwindle and go down, and we have less and less pure ores, it becomes more and more difficult to extract, even in areas where we know it exists. There needs to then be a natural shift to how do we then find other ways of supplying these resources? How do we create new resource pools? And where do they come from and how? And I think Genomines is unlocking access to territory and access to nickel in areas that mining companies were not trying to do it. And I think that's the key point, right? Is it's not saying, here's your nickel mine, we're going to make it operate, 30% better, 30% cheaper, whatever those metrics are. Or here's your pit tailings even, we're going to like try and recapture some resource that kind of has been wasted. Is actually opening up a whole new supply option that previously was just not available. And I think that net addition piece is very important.
And is it a trade-off between traditional farming and then farming nickel? Like, is it like, are we taking away space from farmers to do something else, or are we actually using different pieces of land? In which case, there is no like external, like I'd say, negativity aspect as part of the idea.
Yeah, negative externalities.
Exactly.
No, I mean, as far as I'm aware, the core sites for this are nickel-rich soils, and so they're not used for crop farming today or arable farming, like arable food production today. So I think it's actually also giving hopefully a benefit in that those landowners and those farmers and whoever it is that's kind of going to be in those local communities can hopefully also get more value from that land and from that terrain than previously they were able to do.
I guess something else for me to explore, and we briefly touched on it already, but so the round was co-led by Engine Ventures and Forbion. Engine Ventures is a spin-out of the MIT, first time that they invest in Europe. Largest European rounds in climate tech, right, for Series A. And all of a sudden we have US investors on the cap table. What do we think about that?
I mean, I think that there is a continued kind of trend that I don't think is necessarily about US or non-US, but I'm happy to kind of play that game if we want. But I think the question is like, who is going to build conviction first and independent of others? And I think that what the best funds tend to do, in my opinion, is they build high conviction about a company, even if other people aren't trying to necessarily lead that round. And they're independent thinkers, right? They're not chasing the next thing that everybody else is chasing. And I kind of think that that is the game that people should be playing, right? Is what's the thing that you're seeing that other people aren't necessarily seeing? And maybe there are going to be some companies, I'm sure, where everyone sees the same thing and they all want to get in, they all want to lead, and that can happen. But I think in this particular instance, it took the engine and the conviction that they built around this approach in the space and their own willingness to be that lead, right? Say, we believe in this, we're not waiting for someone else. That was very helpful. And I think that the US still does tend to have a modus operandi that is more aggressive, that is more fast moving, that is more high conviction than some European funds and some European investors. And one of the challenges I think we have, if we like broaden that out to the more macro environment, is too many followers and not enough leaders. Too many, I think, funds where the core strategy is to be the top up, is to be the follower check, is to be the person that, you know, comes in once the kind of diligence and the conviction's been built. And that's great. That's like a necessary part of the capital stack. But I think we really also need like high conviction funds that can lead rounds. And there are some of them in Europe for sure. There are a number of them in the US, but I think it's also a question of mentality. Like, are those investors really taking that lead position and understanding that part of their job is to say, I believe in this and therefore I'm going to invest because that's, you know, something that's aligned with my thesis and my worldview. And I'm not falling into kind of the VC groupthink trap of, okay, this is a deal that nobody else is talking about. This is a deal that other people have concerns on, or whatever the narratives could be in any given deal. And I think that in this particular instance, it was a US fund that I think really took the baton and crossed that chasm. And then unlocked a lot of other interests and other, you know, participants in the game. So I think it's not necessarily US or Europe. I think it's more about what's the mentality of the fund and how can we have more, I think, high conviction investors in the space, right, who are willing to take on that responsibility.
What is also interesting is how they managed to have, you know, probably top tier funds to invest, but also coming from different regions. So there is a US one, there is a German one, French one, Dutch one, each coming with a different angle in terms of the industry expertise and the geographical region. And that can create a lot of support and lever going forward in the future. So it's not only, you know, 4 funds coming from Berlin with the same networks and same expertise. I think this is very diverse and complementary.
For sure. And I think something else interesting as part of the cap table, there is Hyundai coming as a strategic investor, as a CVC. They're also running a pilot with the company. Julien, I guess a question to you, like, is that the way we unlock deal in climate right now? It's like we need to have a corporate that says, I'm willing to not only be an investor, but also a customer of the company.
I don't know if, I mean, 2 things. First, having corporate as customers is probably very, very important in that type of rounds. So you need to demonstrate that you are able to create a product that you can sell to your end customers, which can be, you know, large corporates. So that's something you need to achieve as an entrepreneur. And I would say that's a bonus point if customer can be also investor as well. But probably this is more important at this point to have strong customer traction. And if you can have both, that's probably also a bonus point.
Yeah, for sure. Let's maybe switch to another section of this episode, unless we have something else to say about Genomine. Jonny, Julien, something else?
I think the only other thing, just to draw on an analogy, because we were talking a lot about this as well in the Climate Week and also at the drop, is, you know, people are still challenged with this sort of what people are calling the FOAK gap or FOAK valley of death, or this constant kind of challenge around like, where does the large capital infrastructure come for like CapEx intensive scale up projects? I think also one of the big advantages that Genomines had from a business case proposition is they didn't need that level of CapEx to prove the model out, right? And I think that also makes the risk profile of that type of an investment different to one where, okay, we think this is going to work, but we're going to need to do $200 million in like a factory to kind of like really know that this is going to work. So I think the fact that it is arguably much more capex light than an equivalent solution in our space, that it's about, agriculture and plants, and then using that to kind of process and so on. And yes, there's some processing work, but the volume of capital that's needed in order to get this to a place where you can have high conviction of saying this is viable, it doesn't have that same headwind that a lot of the other companies that are building physical assets will run into. And I think that's also an attractive part of the deal. I think there are other ways that even when people are looking at physical infrastructure projects, can try and bake that thinking in terms of like modularity, or in terms of incremental steps in the scale up, or proving out key elements sequentially rather than doing the whole thing. But I do think that the level of capital that one needs to raise in order to prove something out does give investors either kind of more fear or less fear. I can't think of the opposite phrase of that. So let's go with that. It does make a difference in the psychology of the investors, right? Because they may well believe that you can do this at A, but then if to get to B and C, they know that you need to raise hundreds of millions of dollars, there will be that question in the back of their mind, just like, where is that capital going to come from? Who's going to provide that? Like, are we sure that this is going to be able to be accessed, even if the technology looks good and can work? And I think especially with the Trump administration and the kind of rug pull on a lot of the grant funding in the US, or government match and so on and so forth, I think that's also a more acute issue now for a lot of people, is where is that kind of big capital checks going to come from? How are people going to cross that chasm? And I think in the Genomines case, that modularity and low capex play was probably very advantageous for them. And I think people can try and think about how can they replicate something similar, even if they do need to do something capital intensive.
Well, let's switch topic. I think love to talk about corporate VCs. We were all at the drop a couple of weeks ago. It feels like 50% of the people that were there were corporate VCs. I mean, my stat is probably wrong there, but that's my impression of it. And I guess there's been a lot of recent news around that. I was looking at a Microsoft deal with Stegra, where they are an investor and also a customer now, buying over some green steel from them for their data center. Was looking at a report from PwC that says that about 30% of the deals in climate include a CVC. Julia, from a data perspective, do you see a growing trend in terms of like CVCs taking over the climate tech space and taking over the deals?
They're certainly becoming a lot more involved. And I think the way that they are choosing to play in the space is changing a little bit. So you saw a lot of them being formed in this like climate tech boom of 21, 22, 23. And then I think they were thinking of it as like, this is a cool thing for us to have money in. We can diversify a little bit. Now what I'm hearing from CVCs is that what they invest in needs to be somewhat strategic for their business. So they are still thinking of it as like traditional investors. They don't want to be the only customer. They want there to be a really good potential for growth for the company. But they have a huge amount of expertise to draw on in terms of just the technical experts that they have. So especially when they're sort of like hard tech companies themselves, and I'm thinking of like Siemens, BASF, BP, Toyota, they can leverage all of that expertise and almost be like networkers within the company. So they find a startup, they introduce them to the innovation group, then that leads to a new business unit. So I think it was first like a little bit of FOMO, worrying that they were going to miss out on something big, thinking about how the company could pivot around net zero targets. Now I think they're being a little bit more choosy. But they definitely have a really powerful role to play there as effectively de-risking the tech in some sense. Because like if you are going to sell steel and you're already selling to an automaker, the other automakers are going to feel like someone's tested that out for them.
Julien, is that your view as well? Like, are you a strategic investor on every startup, or are you also coming as a pure financial investor from time to time?
I would agree with Julia. We see a rise of a very hybrid approach, right? So what we see is that there is a huge diversity in the CVC. So usually people say, "Hey, the CVCs," but it can take different forms already in terms of single LP from the balance sheet, CVC as a service, etc. And then the operating models can also be very different, right? So what we see, what I've seen in the past years is definitely a great alignment between the CVC activities and, in general, deep tech, but focusing highly on climate tech. If we look back a little bit, maybe 10, 20 years ago, the CVCs were definitely not the cool kids to hang around with. They were interested in digital stuff, but they were also struggling with the digital transformation. So there was like a lot of friction. Today, as Julia was saying, if you think about BASF or Sony or Airbus or Honda, they are all tech companies with a lot of R&D capabilities. So capabilities to understand the technology, but to be supportive. I think that's somehow what we see as the main trend. There is now also interesting ways, I would say, for broad open innovation units to engage with the startups. So the CVC is one. The strategic projects can be other ones, and there is also all those topics on offtake, being a strategic customer, sometimes even a strategic partner, that can happen. So all of those aspects we see are taking place. But at the end, my advice to the other CVCs is to always think that you need to provide both financial value and strategic value. I think it doesn't make sense to invest in a strategic company which is bankrupt next year, but on the same time, it doesn't make sense to invest in companies which are completely disconnected from the core of the company and what you can bring and what you can create as mutual value.
I just wanted to rebound on that because I think it's a super important point about the strategic thing, but I also feel like there's suddenly the realization of the truth that most exits are going to corporates in climate, right? Like the huge majority of exits in climate are not IPOs, public markets, The huge majority is M&A, and the huge majority of those actors are corporate actors. So I feel like we've known that data has been available for a long time now, but it feels like both the industry is waking up to that from like a VC point of view, and the corporates are waking up to that more from a CVC point of view. And I think those two things are starting to converge a bit more as a result, which is kind of saying, hey, we have a really important potential innovation kind of ecosystem here that could ultimately become important acquisition targets for us in the future. How do we also get involved downstream and upstream, downstream, whichever way it is, and try and like give value and create new models? And I was personally kind of shocked coming away from New York Climate Week that the most interesting or novel ideas around like co-financing with purchase agreements and equity and stuff like that, this was all the corporates talking about that. Like the VCs were still just like, we invest, 10 and 2, we invest, we write checks. All the kind of interesting ideas that were a bit more like, we noticed that there's this problem that all our companies that we were working with face. The Microsoft one's a good example of like invest and procure. And that could be, supply chain access, that could be like first customer, that could be tech validation, that could be tech development stuff. But it feels like corporates are also developing some more innovative offerings for that space. And also the space is realizing that the corporate market is a very fertile market for M&A and for a potential exit outcome for some of these companies. So I think it's like a really interesting convergence that's happening at the moment.
Yeah, a lot of the creativity, I think, around these other forms of funding is coming out of when a lot of these corporates were worried about their scope 3 emissions. So like, how are they going to deal with that? How are they going to get materials? And for a long time, there was all this angst about like, my project is here, the materials are here, what do I do? And the thing that came out of it was different forms of financing, like book and claim. And I think they're using that playbook in a lot of other places now.
Yeah, if you look at the deal from Microsoft, they actually purchase a energy attribute certificate from the green steel. I don't know if it's an EAC or like what's the other form for it for green steel, but like similar concept. So actually also not only purchasing the steel, but also owning the credit for it and therefore reducing your Scope 3, which it's completely right. But guys, quick questions. I guess like corporates have money. For some of them, like investing 100 million per year is like, let's say 10% of their profit. They have the strategic component. They really understand the business in climate at least, and they want to decarbonize. What's a place for climate VCs in all of that? You know, what role should we play as climate VCs, or should climate VCs play in that industry?
I believe that there is a clear symbiotic relationship which can be created at the cap table level between the VCs, the CVCs, and the family offices actually. So I think there is a clear complementarity in terms of the timeline, in terms of the time horizon, time constraints of the funds. There are definitely clear complementarity in terms of the expertise and the potential points of focus, right? So I think it's not. I think the future is really about this symbiotic relationship between the VCs and the CVCs. Oftentimes, depending on how the CVCs are structured and also their maturity, you will see that they would have a lot of focus on the product, on the go-to-market, and maybe a bit less on governance or hiring or supporting on the talent part of the startup, which VCs usually are very good at, like scaling, etc. Right? So that can be some type of complementarity, but in general, I believe it works very well together.
Yeah, I don't think you're gonna. I don't think the CVCs want to go it alone. Not many of the ones that I've spoken to have been like, we want this thing, we want to keep it ours, we want to be the only customer. Not many of them want to do that. But I think it's also about the different areas of investment. So Jonny, to your point about someone has to be looking ahead and thinking about the new thing where other people aren't, I think that is also what Climate VC does very well. Because if CVCs are going to be tethered at least a bit to what their companies do, you're always going to have sectors that are sort of missed out. And so I think that's a really important role that the climate VCs play, is like the scouting, the introducing, and then the scale, as Julien said.
And is there also like a question maybe around like the stage at which CVCs should invest versus climate VCs? Like, are maybe climate VCs supposed to go earlier, take more risk, and then as a company matures a little bit, CVCs should come in? Like, what's a typical stage at which we expect a CVC to come in into the cap table?
Two things here. The trend that we see is that the CVCs are going a little bit later now. So more around the Series B than around the Series A or late seed, as they were doing a few years ago. There are some reasons to that. And one is, as we discussed, maybe the need for more integration with the, with the mothership, etc. So that's one thing. I think in general, corporates are not really good to engage at ID stage. So as long as there is some prototype, MVP, proof point, the CVCs or in general the open innovation units are able to activate, right?
Yeah, I mean, I think as a like general like basic mental model, I would generally agree that VCs come earlier than CVCs, right? And I think in a way, Julien, you're saying that because you come at like post A, B, C. Like I think corporates want to see some stuff, right? They want to see something they can get their hands on, something that they can look at, something that they can diligence and review. And I think it makes sense also in terms of their strategic value to be able to be the ones that do that. I think the other thing that we sometimes think about, and I'd be curious also to hear your take, is how early do you want corporates involved based on how strong is the company to not be consumed by the corporate? And I think that especially if you're in markets where one potential customer is a potential competitor of others. I think there's also like a stage at which you're able to better negotiate non-exclusivity, you're able to better protect your interests for the wider market and still work with that investor either on the cap table or as a customer as well. And I think sometimes if that happens too early, that the negotiating power is just too weighed in favor of the corporate actor. And that can also then be actually problematic from a value creation point of view from everyone involved, because it limits the potential upside to that particular engagement and makes it heavily context dependent. But I think that from what I've seen, at least, that, CVCs did, I think even 5 years ago, have a bit of a bad rap as being like, try to avoid them if you can. I think there's been like a big swing, in my opinion, on that, especially in the last 5 years, of like, actually, these guys know what they're doing. They have the right access. They have the right tools. They're potential great customers, et cetera, et cetera. And now I think a lot of companies are thinking more about, when do we think about bringing a corporate in, rather than should we bring a corporate in or not. And I think that's been a mentality shift, certainly, that I've seen in this ecosystem in the last 5 years.
Yeah, and just from a data point of view, I was reading a report before this episode. Apparently, in 2024, 61% of all corporate VC deals were either mid or late stage deals. So, that confirms kind of the trend. But look, I guess one last section for today. That's a bit of my hot take and being a little bit pissed off by traditional media. But let's put it that way. I keep seeing in every media that climate tech is dead, that dual use is a new thing, or resilience, whatever that is. All of you have been at many conferences recently, New York Climate Week, The Drop, and others. What's your take? Is climate tech really dead, or are we just trying to have clicks on articles in traditional media?
I think everyone got back from The Drop in Sweden and then New York Climate Week, and unfortunately there were only 5 people there. The rooms were pretty empty. There were very few events. Nobody really showed up, actually. It was just kind of me and a few. I think me and Julia were there, and you, Hugo. And that was about 80% of the population at both of those events. I mean, look, the opposite can be, the truth can be further from that. Everyone was still there. New people were there. New money was coming into the ecosystem. I met multiple families who were just starting their journey into climate, right? Just starting allocating into the space, far from leaving. And it would be false to say that there aren't some headwinds. And yes, there's less government support and the Trump administration, all these kind of things. Yes, these are all true. But I didn't feel at all that we were kind of going to be, the violinists on the Titanic, just waiting for AI to consume the world whilst, we forgot about climate change and global warming. I don't think that was the mood music. I think, if anything, the mood music was, this has been a great wake-up call in terms of making sure that we're building incredible companies that happen to have a really positive climate impact. And I think that's the narrative, right? I think that's the key point, is whether we talk about resilience, sovereignty, dual use, I don't care. It doesn't really matter. What we're talking about here is it a company that objectively should be built, that objectively should exist, that objectively drives value for its customers, that objectively can capture value in a venture scale way? And those companies that are climate become climate tech companies, right? And I think that climate is a theme and not a subject. It's not a sector, it's a theme. I think that remains true. And I think everyone in the room that I met, at least, or everyone, the conversation and narrative was not about, this is dead. We need to kind of rebrand. We need to kind of get away from everything. It was more just kind of, hey, actually, all this stuff could actually be very interesting tailwinds for us, right? We need more power. We need more materials. People care about sovereignty. People don't want to rely on Russian gas. People are more and more questioning global trade. So we need more domestic production of key things. And these are all trends that could very, very easily accelerate the types of technologies that we care about in the climate world. Climate tech is dead. Long live climate tech. But I don't think that, at least from where I'm sat, that we need to be worried at any point soon.
I would agree with that. I think what this kind of reminds me of is when I first started working in climate back in 2015, where it was all about we want to reduce emissions, but at the same time, we're going to help emerging economies get power faster because solar is so much quicker than building a centralized gas plant and building transmission. Or it was, look, corporates buy a PPA because you can lock in a price and know how much your electricity is going to cost you. So it's always been emissions and something. And I think around the Paris Agreement, there was this like joy in the climate tech community because we could just talk about climate for a while. But I think that was a little bit of a blip. And now we are back to this thing of reducing emissions and what are you giving me? And there's lots of people who are overjoyed at what's happening in climate tech right now. The nuclear people are excited. Geothermal is excited. Grids are doing a lot more. And all of that is fantastic. And those are the things that have very clear and associated with them.
For me personally, the canary in the coal mine for feeling like something is really broken in our ecosystem is when companies that really are great companies that shouldn't be failing for any other reason than there's just no capital to finance them start to fail. And I haven't seen that happen. I've seen companies die, question whether they shouldn't have died anyway, right? Like I think there's been some solutions that got funded in that ZERP era that were just not a good idea. And yeah, they raised like tens of millions of dollars or sometimes hundreds of millions of dollars in that frenzy. But I think we need to be a bit ruthless about the idea that, you know, every company should exist and every company is a good idea. And just because they've raised a bunch of money, it means it's a good idea. I think the thing we should all collectively be very worried about is if great projects working on great technology with like demonstrated value, with demonstrated customers who need to get to the next stage, just cannot get access to capital and end up dying because of those reasons. I think that would be like a real big problem for our ecosystem. I think what we're seeing right now is like a sharpening of the pencil and a hyper focus on what is really worth putting dollars or euros into. And overall, I think that's going to be a real net positive because I think it means we're going to build better companies with better propositions for industry, for the world, and ultimately have a better shot that they actually get to scale, which is what we're all here to do. So, you know, I think that would be a bigger worry for me than what I saw over the last few weeks at conference.
Yeah, there is something called the Great Wealth Transfer or something like this. So it will be trillions of wealth, which will go from the baby boomer generation to, you know, millennials, etc. That will happen in the next 15, 20 years. What the data shows is that all those, you know, family offices, they are more into private market investment. They are interested in impact. They are interested in ventures and funds. So it will create, of course, some capital. It will not be some magical money to be deployed everywhere. So they will look for, and they are already looking for the good deals where they see also a path for return. But that will be, I think, an interesting force in the coming years, as Jonny was mentioning. And as we are transitioning from a, I don't know, vertical to an horizontal, and when at a time when every business is somehow a climate business, more or less, I think this is important to also keep in mind the needs that we have, right? So despite some geopolitical challenges sometimes, etc., we did a lot of progress in terms of implementing renewable energies, and we still have a lot of opportunities there with innovations which are, you know, about to scale, like energy storage, etc., and a few other ones which need to be deployed. So I agree, and I didn't feel a kind of bad mood. I see more a kind of a focus on pragmatic solutions, combination of technology and tangible business results, which are also very good to take, right? So that's the kind of feedback from my side.
Yeah, and I guess to wrap it up, Genomines was one of the latest and greatest Series A round in Europe, at least in climate tech. So, recent news proving traditional media's wrong. And, family offices is not only from a data perspective, that there's a lot of capital, but from all of the conversations that people have, like I keep hearing that same story that next gen family office want to invest in climate. And then we also have this other trend, which is corporate VCs coming more and more into climate. So all in all, doesn't feel like climate tech is dead, my friends. We'll have to talk in a few more podcasts for a few more years, I believe. But look, thank you so much, guys, for today. It was a pleasure.
No, it was great to chat with you both. Thanks so much for having us, Hugo.
Thanks, Hugo.
Keep on making waves. Bye.